And these are, well, not very frequently used method of I guess capital accumulation or whatever, right? Well, I guess we will just briefly cover these concepts. Yeah? So rights are, again, the options, okay, given to existing shareholders, okay? And it's also called the first right of refusal, okay? The full, I guess, first right of refusal. Yeah. And it is related to preemptive right to avoid involuntary dilution. Okay. These are all related concepts. Yeah? So I'm pretty sure you remember the concept of involuntary dilution, right? When a company issues additional stocks, additional shares, right? Then existing shares, the ratio, the percentage goes down, right? So EPS becomes lower, right? Because now you have more shares outstanding in the market. Okay? So when a company wants to issue new shares, in order to protect their current existing shareholders from this involuntary dilution, right? They give a preemptive right or first right of refusal to their existing shareholders, okay? By allowing them to purchase the new shares first. Okay? So before they sell the new shares to the market, open the market, the new shares to the market, right? They notify their existing shareholders that, well, we're going to issue some new stocks, new shares. Okay? If you want, okay, you can purchase these new shares first, okay, before we open it up to the market. Okay? And there will be a strike price, okay? And in this case, strike prices are usually lower than the market price, okay? So if current market price is, say, $30 a share, right? And say, well, existing shareholders can purchase the new shares at $28 a share, okay? And then they would also specify a certain number of shares required to purchase each share, right? So, in order to protect the proportion, right, of existing shareholders, right? Say, in order to purchase one new share, you need to have 10 existing shares, something like that, right? So every 10 shares you hold, you can purchase one new share. Right? That's the idea. Yeah? All right, so it's called the preemptive right. Well, it can also be used without the preemptive rights, okay, as just a way of selling new shares. Okay? But that kind of case is increasingly rare. Right? So, in other words, most of the times these days when you see the rights, okay, these rights are involved with the preemptive rights, or in order to avoid the involuntary dilution. Okay? Couple of things we have to understand there. It's called subscription price instead of strike price in the case of rights offering. Okay? So subscription price, as I said, is usually below the market price. Okay? And there are date of record and ex-right day. Okay? So let's say December 1st, let's say, okay? That the company announces that we are going to issue new shares. Okay? and well, the existing shareholders will get the rights. Okay? Then they will announce a couple of dates, date of record and X rights date. Okay? So what it means is if you are holding these existing shares on the date of record, which is, say, December 8th, right? Then you will be allowed to purchase the new shares. Okay? You receive the right. Okay? But in order to get on the record, it takes usually a couple of days. Okay? So what that means is 2 days ago, 2 days before the date of record, okay, you have to be holding the stock. You have to purchase this particular stock until 6. Okay? And so once the company announces the new issue, the right, new issue of the right, then it's called the right-on price. The stock price will be called the rights-on price. Okay? And rights-on price will continue until X right date. Okay? So on 6th. Okay? And after the X rights date on the 7th, okay, Wednesday, okay, the stock price will go down. Okay? Because holding this stock will no longer guarantee that you will receive the right. Okay? Because if you purchase this stock on the 7th, it takes 2 days to get on the record, right? But you have to be on the record by 8th to receive the right. Okay? So that's what this X rights and date of record talking about, right? So rights on price versus X rights price. Okay. Of course, rights on price will be higher than the X rights price, because if you're holding the stock which carries the right, then you have, of course, advantage of purchasing another share, right, at lower subscription price. Okay? But after the X right date, the stock doesn't have that option, right? So the price will go down. Okay? So we can think about this, the value of rights, because rights can be actually detached and sold in the market. Think about this situation. Okay? You are holding certain the company's stock, okay? And they've announced the new issue, and they've announced the right. Okay? But in order to purchase the new share, you have to pay money. It's not free, right? You have to pay that subscription price. Okay? But let's say you don't have extra cash sitting around. Okay? So right now you're not interested in purchasing more stocks. Okay? Even though if you don't purchase additional shares, your share will go down, right? Your percentage holding will go down, right? So you cannot preserve your right, the voting right, for example, right? But anyway, so let's say you decide not to purchase any new shares, okay? Then you can actually sell these rights to someone else. There is a market for these rights, okay? So the question is, what will be the price of these rights in the market? Okay? So you can think about that situation. Okay? Here are the formula. Okay? The R is the formula value of the right. Okay? And between rights on and X right situation, okay, R will be the same. Okay? The formula value of the right will be the same. The difference will be MO and ME. Okay? MO is the rights on market price of the stock. ME is, of course, X rights market value of the stock, X rights price. Okay? So the difference between, when you think about these, so this is MO and this is ME, right? The difference between MO and ME will ensure that R remains the same. Okay? So in other words, MO minus ME should be equal to R. Okay? So in these two equations, you can actually substitute MO with ME plus R and solve for R. So if you have actual numbers, okay, actual numbers for MO and ME or ME whatever, right? Then you can substitute MO here with ME plus R, okay, and solve it for R. That is how you can calculate the formula value of R value, the value of the right. Okay. Why don't we think about try some actual numbers here? Okay. Question number 11 at the end of the chapter. Usually it doesn't give you much time, right? You know, typical options, you have 3 months option with 6 months option. You can have quite, significant lengths of time. Okay? But this rights offering, when the company offers rights, right? They don't give you that much time, right? So before they actually issue the new stock, yeah, maybe you'll have to exercise within 10 days or so, right? So it's a very short-term call option, right? You have an option to purchase the new share or not, right? You can, if you don't want, you can just let it expire, right? Or you can sell it in the market, right? That's the idea. Okay. Okay. So that's the idea of rights. Swaps is a final concept that we're going to talk about in this chapter. Right? It's a contract between financial institutions to exchange cash payments based on the value of an underlying asset. That's the whole definition of derivative, right? Derivative is a kind of financial instrument whose value depends on some underlying asset. Yeah? And in the video you've seen, you heard about this credit default swap. Okay? Credit default swap let me just summarize. Okay? Credit default swap, CDS. Okay? Loss on a debt instrument such as bonds, loans, mortgages, okay, are insured by another company at a fee, okay, or premium. Okay. The insurer is required to post collateral which was grossly insufficient before 2008 financial meltdown. Okay? So it's like any insurance. I mean, just like insurance, when you purchase your car, right? You have to insure your car, right? So you pay some premium to the insurance company, right? And you get guarantee that, you know, in case your car gets into an accident, right? The insurance company will come in and pay the damage, right? But in order to do that, insurance company has to save aside, put aside certain amount of money, right? So that they will be ready to pay your damage, right? So the insurer is required to post collateral, okay, or set aside sufficient amount of capital, right? But as you've seen in the video, this credit default swap and CDO, or whatever, synthetic CDOs, right? These were very new concepts, right? So the regulation, the law, right, was not there to ensure that the companies that takes on the risks, credit risks, right, set aside enough capital. Okay? Well, you've seen the conflict between the what was her name, Beverly, someone, okay, and Alan Greenspan. Okay? That lady was in charge of what was it? SEC, I believe, right? SEC, Security Exchange Commission, right? And she testified in the Congress that we really need to increase the supervision and make sure that these companies set aside enough capital, because this is dangerous. Okay? But Alan Greenspan, being a liberal market economist, okay, and he said, well, the intervention is not good. Okay? It's always a good idea to leave it to the market, right? And let the financial market handle the self-supervision, okay? So for that, a few years later, I believe in 2012, around 2012, Alan Greenspan openly admitted his mistake, right? And that was amazing. Because Alan Greenspan, as you know, has been in charge of the Federal Reserve System for almost 20 years in the United States. Okay? And in my opinion, the Fed chief, the Fed chairman, has a lot more power than the president of the United States. Okay? Because what Fed does, okay, it immediately impacts entire world's economy, right? And Alan Greenspan is considered almost a godly figure, right? Because while he was in charge, of Federal Reserve System, U.S. economy was just had so much growth, okay, stable growth, okay? And he admitting his mistake was just unfathomable, right? So that was a huge surprise. Okay? Anyway, so that's the story of credit default swap. Okay? Interest rate swap is used to hedge against interest rate risk. Okay? And the textbook gives a very simple, very good example. Okay? And here's a finance company. Like, say, Hyundai Capital. Right? I'm sure Hyundai Capital started as a finance company for Hyundai automobiles. Okay? Say, in the United States, there is GMAC. GMAC has started as a finance company for GM automobiles. So when people buy GM cars, okay, they were able to, GMAC provided financing, right? Honda, Honda Financing of America? Yeah, Honda Financing of America, something like that, right? That they provide financing for Honda automobiles in the United States. Right? So a lot of these financing companies, Ford, the same thing, right? They start as the financing company there for their vehicle, right? And then they get into some other businesses. Hyundai Capital is big in credit card business now, right? GMAC got into mortgage business, house mortgage business, and they had a lot of loss because that housing crisis. So they, I think, sold the mortgage business to someone else. And anyway, so let's say here's a finance company, and they borrow at variable interest rate, okay, or floating rate, okay? And they lend at fixed rate, let's say, okay? So when people buy houses or cars, they can agree on certain percentage, right? Say 7.5%, right? Annual interest rate. Okay? So this company borrows at variable, lends at fixed. Okay? Then we got a problem. There's a risk here. Okay? So, no matter what happens to the market interest rate, your income stays the same because you have lent your money at fixed rate. Right? But when the market interest rate goes up, you have to pay higher interest on the money you borrowed. Your cost increases. Okay? So when this company loses, when interest rate rises, that's the problem. This financing company will lose or have difficulty when the interest rate rises. Okay? On the other side, there is a bank. Right? And here the assumption is bank borrows at fixed rate and lends at variable interest rate. Okay? So maybe they issue the bond at fixed interest rate, right? And that's how they raise the capital. But when they lend, they promise the variable interest rate to companies or individuals, okay? So this company will have problem when the interest rate goes down, right? Because their cost is fixed. Their interest cost is fixed, right? But when the interest rate goes down, then their income from the money they lent, right, will go down, right? So this company loses when interest rate goes down, okay? So if you have this kind of situation, then these two companies can come to an agreement, some sort of agreement, okay, to reduce the risk or eliminate the risk, perhaps. Okay? Let's say this is A, this is B, right? Then let's say A pays B at fixed rate. Okay. And B pays A if interest rate rises above certain rate, above certain rate. Okay? Okay? Because again, B is the company that loses when the interest rate goes down, right? But when the interest rate goes up, they make money, right? Because their cost, borrowing cost is fixed, but they lent at variable interest rate. So when the interest rate goes up, they make money, right? So when interest rate goes up, right, then this company will pay A at certain amount if the interest rate rises above certain rate, right? And but A will pay B at certain fixed interest rate, okay? Because their cost is, or their income is fixed, right? Here. They lend at fixed rate, right? So they can do that, right? Their income is fixed. Okay? So when the interest rate rises, B is making money, but A's cost increases, right? So they will, I guess, match their weaknesses and strengths, okay? And they will help each other depending on the situation, whether the interest rate rises or drops. Okay? So that's a very simple example of interest rate swap, interest swap, okay? Between two financial institutions. Okay? Okay, so that's it for the rights and swaps. Any question? Well, just review the concept. Let me know if you have any question. Okay. Let's go on with Black-Scholes option pricing model. Okay. And this is, you have to understand this to do your project. Okay? Question number 3 okay? Is asking you to compare the option price on December 8th. Yeah, if you read the question, So sometime between 7 a.m. and 10 p.m. on December 8th. Right? Why do I require you to get this information between 7 a.m. and 10 p.m.? Because that's the time when the market is closed in the United States. Okay? So I want you to get the, so what you're going to get between 7 a.m. and 10 p.m. on December 8th is actually closing price on December 7. December 7 is Monday, right? So 7 a.m. will be 5 p.m. Okay, on December 7, 5 p.m. in the United States. So between 5 p.m. and 8 a.m. the next day. So while the markets are closed, okay, I want you to get these prices. Okay? So you can compare these prices to the Black-Scholes price, okay, and see what happens. Okay? So you calculate the option price based on the Black-Scholes method, and you're going to compare that estimate to actual option price. Okay. Okay. So here, Black-Scholes option pricing model is developed by two people, right? Fisher Black and Myron Scholes, and they actually wrote this paper in 1973, right? 1973, but about 24 years later, in 1997, okay, they were awarded with Nobel Prize, okay, for their contribution. Well, actually, only Myron Scholes received the prize because I believe Fisher Black was dead, okay, by then. Okay, okay, unfortunately, right? Okay, so here are some assumptions. Again, economists make a lot of assumptions. Okay? And the assumptions are stock pays no dividend during the life of option, and we also assume European option, which means it is exercised only on expiration day, right? Only just one day, right? Not before the expiration. Right? Stock price follows a random walk. What is a random walk? What does that mean? Huh? Cannot be predicted. In other words, no pattern. There is no pattern. Right? It's randomness in statistics means we don't know. There is no pattern. There's no way to predict. Right? It's like drunk person walking. Right? Random walk. Right? No transaction costs. Stock returns are normally distributed. Okay. And short-term risk-free interest rates are known, and they remain constant over the life of option. Okay, that's another very interesting assumption. Okay? Short-term risk-free interest rate. Okay? Yeah. Okay, for short period option, short-term option, it may be realistic, right? Volatility or variance of stock return is known and constant. Okay? So under these assumptions, you can use this formula to. By the way, this is in your chapter in your textbook, right? As an appendix to chapter 20, right? Okay, so this formula is quite complicated if you think about it, right? Here, D1 is log of PS, which is the current stock price, divided by exercise price of the call option. Okay? And R is the risk-free, short-term risk-free interest rate. Okay? Sigma is, of course, variance or standard deviation, right? So sigma square is variance, okay? And T is time until the expiration of the option. But time in years, everything is in years, okay? So if it's a 6 months option, if your option has 6 months remaining until maturity, until the expiration, then it's going to be 0.5, right? If you have 3 months remaining until expiration, that's going to be 0.25, right? Okay? 0.25 year. Okay. All right, and D2 is D1 minus whatever, sigma square root of T. Okay. And here, N here, what is N? N is the value of a cumulative normal density function. Normal density function is itself is quite complicated. I'm sure you know, right? The probability that a standardized normal distributed random variable will be less than or equal to the value of D, right? So actually, what they write as ND1, okay, is that's actually the probability that Z will be less than D1. In statistics, we write it this way, right? So when you have a standard normal distribution, okay, whatever, if you have D1 here, okay, what's the probability that your Z value, standard normal variable, will be less than D1, right? Okay? All right? The same thing with the ND2, right? So this formula is kind of formidable, right? And I'm not asking you to actually use this formula. You don't have to. There will be the computer software templates already available, right? So you're going to use the computer software to calculate this option price. Okay? Oh, E is exponential value, or what we call natural constant, right? 2.7182 whatever, right? Okay, all right. Okay. So let's see. Another thing you have to understand is how to read the option table, option quotation, right? Which we didn't cover. I don't think we covered that. Okay. So let's see. Let's go to CNBC.com. Of course, there are many other sources of option quotation, right? But okay. Okay. Yeah. If you just type any symbol here, Amazon. Okay. Oh, what happened? Unsupported browser. God, this is crazy. AMZN. Okay, then you got this some overall stock quotation information for the company, right? And well, I guess this is the problem. I guess this unsupported browser is not going to show this chart. And anyway, here's the options chain. So click on options chain. Okay. $676. Wow. Yeah. Okay. All right. So here, if you look at down here, it says call and puts. What you see on the left side are call options. Right side are put options, okay? And you're going to just calculate the call option price. You don't have to worry about put option, okay? When you use Black-Scholes method, okay? Okay, so we're going to use only the left-hand side, and then expiring in December 15. Remember, American options expire on Saturday immediately following the third Friday. Okay, so apparently, where is it? December 15? This is interesting. January 16. January 16. That makes sense. This first Friday, second Friday, third Friday, so 16 is the expiration date. What about December? December 15? Oh, I'm sorry. Yeah, this is December 2015. Sorry about that. December 2015. And this is January 2016. Okay. So, yeah, if you look at December 15, right? Just click View Options here. Okay. Okay. So, you have to actually calculate the number of days until expiration, right? So make sure you understand. So expiration date, December 2015 option expiration date is 19, December 19, right? That's the Saturday following third Friday, right? And for January, okay, expiration day is 16, right? That's the Saturday following third Friday, right? Okay, make sure you have to count the days, okay? And these are the symbols, and if you look at the last three digits, 250, 260, 270, those are actually strike prices. Strike prices, okay? So here's December 15, December option. We just call it 2015 December option for Amazon. Okay, strike price of 250. Right? Wow. And guess what the price is? Price is $300.50. Right? Does it make sense? Right now, the stock is selling at $676. Okay? And if you hold this option, that allows you to purchase this Amazon stock at $250. You can pay only $250, right? And for that, you have to pay $300. But if you add that, that's only $550, right? I would buy that. Right now, Amazon price is $676, right? So, what happens here? Volumes are zero. I'm sure there are people who are willing to buy, but nobody is willing to sell, right? That's the story here, right? So, if you go down close to $670 strike price, you'll see a lot more action. Yeah? Yeah. If you go down to around 600, you start seeing the action, actual trades. Okay, and 600. Yeah, you'll see a lot more actions here, close to 600 current stock price. Okay, that's the story. Okay, so this is a slightly different format. Okay? In the old days, they used to show bid price and ask price before the open interest. Okay? Bid price means that's the price that buyers are willing to pay. Ask price is the price that sellers are willing to, well, sellers are asking, right, to receive, right? So only if bid price equals ask price, or if bid price exceeds the ask price, then the transaction will occur, right? If bid price is less than ask price, then it will remain open. Okay? It's called open interest here, right? Open interest, 1 unit. These are a number of units. I think I told you each unit is 100 shares. Okay? Okay. So if you go down here, there are some open interest, 812 units remaining, right? Apparently there is some gap between the bid price and ask price. Okay? And this is the last price. It's a little bit dumb. If it's an Excel spreadsheet, we can make this label stay by freezing the spreadsheet, but apparently we cannot freeze this line. Okay. Anyway, so that's the last trading price change from the previous session. Low, high, volume, how many units are traded actually, and open interest, okay, how many units are remaining, okay, in the market, okay, and so on. Okay. All right, so if you read the question, okay, compare the prices option to the predicted prices you obtain using the Black-Scholes formula. Okay. So I want you to compare the December 2015 call option and January 2016 call option. Okay. Okay. Why don't I open it up for you? Wait a minute. Okay, so if you read question number 3, okay. 2015 call option with a strike price that is closest to the current stock price. Okay? So what I'm talking about is, here's the current stock price. So current stock price is $677. Okay? So I want you to go to the December option. Oh, where is the option chain? Go to the options chain. Select the December option. It's already selected here. Okay? And go down to close to 677. Go down to 677 around here, right? Something that's close to it, right? And check out the price, right? So check out the price and compare that price to Black-Scholes price that you calculated based on the formula. Okay, that's what I'm trying to say there. Right? If the last sale price is unavailable, right, then find the nearest strike price. Well, if you select a pretty popular company, widely traded company like Amazon, okay? And if you get to the nearest, the stock strike price close to the current price, then you'll probably see the actual last price, right? But if the strike price is far away from current stock price, then you will see a lot of these zeros. Okay? That means these options have never been sold, or the actual trade has never happened recently, okay? And so on. Okay? That's what I'm talking about. Okay? All right. How do you use Black-Scholes? Okay, here we go. X. All right. Here's a Excel template. I'm going to upload this Excel file, right? So all you need to do is just say Amazon, something like that. Oops. And just whatever, right? Okay. Just enter the numbers like 677.5, right? And exercise price 677, whatever, right? Right? And duration in years. How many days remaining until the expiration, right? Annual risk-free rate. You have to find this risk-free rate. You know how to find the risk-free rate, right? Go to the, well, since you will be dealing with American stocks, I think it makes sense to find the risk-free rate from the Treasury bill rate, right? American Treasury bill rate, okay? And then you can also find the volatility. You have to do some search, okay? And find the stock volatility or standard deviation, okay, of your return, okay, from the internet, okay? Or if you want, you can actually calculate it. You've done that, was it last semester? Okay? You can actually download, you can go to maybe Yahoo Finance, okay, and download the last 3 or 4 years stock return, stock price, okay, and calculate the return. And then you can calculate the, I may have it here, okay. I have it in Finance 1, I believe. All right. Just download, let's say, last 3 years. You can do daily or monthly, whatever, it doesn't matter, right? Say 2008, January, February, March. Okay? But you have to specify the date, either January 1st or January, yeah, I guess 1st would be good, right? First day, okay? And say AT&T stock price, closing price. So those are monthly closing price, okay? And then you can calculate the return. Return will be what? This one, February 1 price minus January 1 price divided by January 1 price. Right? New price minus old price divided by old price. Right? Then that will give you the return on that stock. Right? Monthly return. Right? So you just copy that formula all the way down. Okay? And then at the bottom, say use the formula STD, standard DEV, STDEV. Just highlight there. And that's going to be the standard deviation of the stock return. right? Okay, you can calculate it that way. Yeah. So try it. And sometimes you have problem with these units, right? So if it's a percentage, you have to convert it into a fraction, like 0.3, right? So here, when you calculate the returns, you better have it as a fraction instead of percentage, right? Then you don't have to convert it back to, okay, you know how to do that, right? Okay, anyway, so you don't need annual dividend percentage. This annual dividend percentage is used to calculate put option value rather than call option value, right? So if you fill out all those numbers, right, then you can just copy the formula from here. Okay, we don't have, let's say, 0.3, 0.4, whatever. Annual reserve 0.01, and volatility, let's say 0.17. All right. Then we got call option value, put option value here, right? So you can use this template, Excel template, or actually there are a few internet sites. You can find some internet sites where you can calculate the Black-Scholes option value, right? Quite similar to this one, right? You just provide these numbers and it calculates the option value, right? Okay, so any question? All right, let me know if you have any question. Okay, so on Tuesday we're going to get into chapter 21. Okay, have a good weekend.